Can the ABSLI Param Suraksha plan balance the dual goals of life insurance protection and wealth creation without compromise in the long term? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So, this is a unit-linked, non-participating individual life insurance savings plan. And some of the key features of this policy are: you get the choice of sum assured multiple as high as 30x basis on your age and policy term chosen at policy inception. And you also get a return of 2x your premium allocation charge from the end of the 10th year to the 13th year to boost your fund value. And you also get a return of 2x your mortality charges from the 11th policy year till the end of the policy term. And there's systematic withdrawal facility available to enable regular withdrawal from your fund value during the policy term to cater to your recurring monetary needs. And there is also a choice of 5 investment strategies and 19 fund options to suit your varied investment needs. And tax benefits may also be applicable on the premiums you have paid and the benefits you have received as per the prevailing tax laws. So see, these are some of the key features of this policy. Now let's take a look at the benefits available under this. Number one is the death benefit, which is given to the nominee or the legal heir in the case of death of the policyholder, unfortunately anytime during the policy term. So out of the 3 options mentioned on the screen, whichever is highest at the date of death of the policyholder, that will be given as a death benefit to the policyholder's nominee or legal heir. Another thing is the maturity benefit, which the policyholder will receive as a fund value. Will receive the fund value as a lump sum amount unless the policyholder has opted for the settlement option once the policy matures. There is also something called the return of charges I have mentioned before, right? So the 2 times your total premium allocation charge, which excluding taxes collected, shall be added back to the fund at the end of each of the year between 10 to 13 years, and 2 times your mortality charges starting from policy year 11 are also added back to the fund. Now let us take a look at the 19 fund options available under this plan, which are Liquid Plus, Income Advantage, Assure, Protector, Builder, Enhancer, Creator, Asset Allocator, Magnifier, Maximizer, Multiplier, Super 20, Pure Equity, Value and Momentum, Cap, Nifty Index, MNC, ESG Fund, Small Cap Fund, Nifty Alpha 50 Index Fund, and Linked Discontinued Policy Fund. So these are all the fund options available, and they're all categorized based on their risk profile, like very low to very high, and also based on the asset allocation percentage each fund might have, either to debt, money market, or equities, according to the number of percentage allocation they have. So these are the fund options you have. Now let's move on to understanding the investment strategies available under this policy. So number 1 is the systematic transfer option, which is a strategy where your premium shall be first allocated to the Liquid Plus fund option, and thereafter monthly 1/12 or weekly 1/48 of the allocated amount shall be transferred to a segregated fund of your choice. So the percentage allocated to chosen fund is an increment of 1%, which can range from 5% to 100%. So the total allocation across all funds must be 100%. So you can choose up to a maximum of 4 segregated funds out of the fund options they have given to you. And next strategy is the Return Optimizer investment option, where your basic premiums are invested in the Maximizer fund and it will be tracked every day for any gain. So the gain from the Maximizer fund reaches 10% or more of the net invested amount, then the amount equal to the appreciation will be transferred to the Income Advantage fund. Thus your gains are protected from future market volatility in this way. Another strategy is a self-managed investment option, where you're given access to your well-established suite of 19 funds. So you have complete control in how you invest your premium and full freedom to switch from one fund to another. The only requirement under the strategy is that the percentage allocated to any fund be an increment of 1%, which ranges from 5% to 100%. So the total allocation across all funds must be 100%. So next option is the smart investment option, where your portfolio will be structured as per your maturity date and risk profile, which is conservative, moderate, or aggressive. And your annualized premium, which is your net of premium allocation charge allocated between two funds. One is the maximizer fund, which is an equity fund. Another is the income advantage fund, which is a debt fund in a predetermined proportion. So over time, this allocation is managed such that it will automatically switch from riskier asset to safer asset progressively as your policy approaches maturity. And another option is the life cycle investment option, where your annualized premium is allocated between the two funds, maximizer and income advantage, in a predetermined proportion based on the selected risk profile and your age when the premium is invested. So these are all the investment strategies available under this policy. Now let's take a look at the various charges we need to pay under this policy. Number one is the premium allocation charge, which is levied on the annualized premium they receive before it is allocated to your fund. Another charge is the fund management charge, which they charge for managing your fund, and it varies from 0.50% to 1.35% according to the risk profile the fund might have. Another is the policy administration charge. So under this policy, there is no policy administration charge in the first 4 policy years, and from 5 onwards, 0.32% per month of the annualized premium increases at 5% per annum on each policy anniversary. Another is the mortality charge. So this is charged for providing you with life cover, and it is based on the sum at risk and is deducted at the start of each month by the proportionate cancellation of units from each fund under the policy at the time. So the charge per thousand of sum at risk will depend on your gender and the attained age of the policy holder. And another charge is miscellaneous charge, which is not present in this policy. And finally, surrender charges. So the charge on discontinuance or surrender of this policy will depend on the year you choose to discontinue or surrender this policy and your premium amount and the fund value. Now, if you take a look at all these charges are significantly high for a market linked product, and these substantial fees will reduce your net premium invested, impacting your returns. As a result, your final proceeds over the long term will be affected. That's why these charges are a major drawback for any ULIP policy, especially for a policy like this where the charges are high compared to other market linked products. Now let us take a look at the advantages and disadvantages present in this plan. So the advantages are, you get unlimited free switches which are allowed under the self-managed and systematic transfer investment option. You can also switch from one investment option to another after the first policy year, and your risk profile switching is applicable only under the smart investment and life cycle investment options, and your future premium can be redirected under the self-managed option, and your premium can be reduced by up to 50% of the original annualized premium after you complete 5 policy years, at least the first 5 policy years. And there are unlimited partial withdrawal which are allowed after 5 policy years, provided the policyholder is at least 18 years old. And there is a settlement option available to claim your maturity benefit also, and riders can be added to the base policy to strengthen your coverage even more. So these are all some of the advantages. Now the disadvantages are, no policy loans are allowed under this plan, and there is no liquidity available during the initial policy years, and the sum assured provided by this plan may not be sufficient to achieve any of your significant financial goals. And another main drawback is your net premium is invested only after deducting charges. So that's also something a major drawback, because your principal amount is all for investing is already reduced, so your returns over time will also come low. And the premium payment is restricted to the annual mode, which limits your flexibility for policyholders. So these are also some of the drawbacks which you need to carefully consider before deciding to invest in it. Now, as we have a basic understanding of this policy, let's move on to the research part of the video. So we are going to analyze the internal rate of return (IRR) of this policy based on the figures they have mentioned in the policy brochure. So just for example scenario, let us assume that a 35-year-old male purchases this policy with a sum assured of 30 lakhs. So the policy term is 30 years and the premium paying term is 12 years with an annual premium of 1 lakh. So upon paying regular premium, the fund value is provided as a maturity benefit. So here we are going to assume the maturity benefit in two assumed rate of future returns. So one is 4%, another is 8% per annum, which is both indicating worst and best case scenario respectively. These are not any guaranteed returns, or these are not representing the only potential range of outcomes that can come from this policy. The actual outcome will depend on the policy's performance. We are just taking this 4% and 8% to give you a better example of how you can expect the returns to in a worst case scenario and a best case scenario, since this is a unit linked policy. Now if you take a look at the worst case scenario, at 4% return scenario, you can see the fund value is 18.34 lakhs, yielding an IRR of 1.74%, which if you actually look at it, the IRR offers no significant value addition to you. And also at the 8% return scenario, in the best case scenario itself, the fund value is 51.72 lakhs with an IRR of 6.06%, which is slightly lower than a low risk debt instrument like even a bank FD. So even a bank FD can give you guaranteed returns better than this, but here we are taking such a long term risk, but the potential return falls short when compared to other market linked investments that deliver higher yields, better risk adjusted returns, and greater transparency. So while the risk is relatively higher, the returns are comparable to those of debt instrument, making the plan unworthy of the risk taken. So the imbalance in the risk return profile undermines this policy's effectiveness in supporting long term wealth accumulation. Now, as we can see that this policy is not giving us the desirable outcome we need. Now what we are going to do is to provide us with a more clearer perspective. We are going to calculate the return of other alternative investments in an alternative investment approach by separating life insurance and investment components instead of investing in an insurance cum investment policy like this. So let us assume that for life insurance purpose that we are considering a pure term life insurance policy with a sum assured of 50 lakhs, which is a minimum sum assured for pure term policy. So which cost an annual premium of 21,200 rupees for a policy term of 30 years and a premium paying term of 10 years. So by opting for this policy, you save 78,800 rupees compared to the premium budget we had for ABSLI policy. So this money we can invest separately. So unlike the ABSLI plan's 12-year premium paying term, this scenario only gives us a 10-year premium payment method, which allows you to invest the full 1 lakh annually after completing the first 10 premium payment years. And as you can see, based on your risk preference, you can either choose equity or debt, but here we assume investment in an ELSS mutual fund by taking account of its previous past track record, where by investing in it for long term we can get higher returns. So by the end of 30 years, the fund value is 1.67 crores, but after accounting for capital gains tax, the post tax value is 1.48 crores. So the IRR for the ELSS investment combined with pure term life insurance policy is 10.53%. So the return here outperforms the ABSLI plan, exceeding inflation and enabling faster wealth accumulation over the long term. So now what is the final verdict on the ABSLI Param Suraksha plan? Is it worth investing or not? As you can see, this is a plan which provides us with a range of fund options and investment strategies tailored to our individual preference. However, these options offer limited value as the plan's potential returns are inadequate for a long-term investment, and the high charges reduce the investable amount, negatively impacting returns and making it challenging to accumulate the corpus we need to achieve our life's financial goals. Because investors generally seek to generate alpha from equity investment to comfortably outpace inflation over time, unfortunately the ABSLI Param Suraksha plan fails to deliver in this regard. Also, it has a high agent commission. Additionally, the sum assured is also insufficient, making this plan unsuitable for inclusion in your investment portfolio. So what you can do instead? For effective financial planning, you can opt for pure term insurance policy for life cover for higher coverage with the affordable premium. So, by separating your insurance from investment, you can build a diversified investment portfolio for wealth accumulation. This alternative approach eliminates the inefficiency of combining insurance and investment.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.